So this is the live lecture for Chapter 6. Chapter 6 discusses cash, fraud, and internal controls. As far as the coverage of Chapter 6 on your next exam, this chapter is very likely represented just because it is one of the chapters in the book that are relatively less important than everything else that we are covering. So let's go ahead and get started. I'll pull up the PowerPoint presentation for Chapter 6, just like I normally do. We'll talk about a few concepts, and then on Wednesday, I'll show you how to work a bank reconciliation, and we'll prepare a few bank reconciliations on Connect and on paper. So I'll show you the worksheet for Chapter 6 and how to do a bank reconciliation paper and pencil. So let's go ahead and go to Blackboard. Let's go to Chapter 6, and I'll pull up the PowerPoint presentation for Chapter 6. I always like to start the Chapter 6 discussion by addressing fraud. So I'm not going to, I'll just pull up slide 4, and I'll stay on slide 4 here for a little while. So back in the early 2000s, there were a number of accounting scandals that were addressed by Congress. One of the big names, one of the companies that started it all was a company named Enron. So Enron was one of the fastest growing companies, most successful companies of its time. They were in the energy business. They were based in Houston, Texas. And one of the things that they did when it became apparent that they involved in an accounting scandal and all kinds of fraudulent activities was that they falsified their revenues. You guys are educated users of financial information now. This is week 8 of class. So you know what happens if the company falsifies their revenues, if they increase their revenues. So if you overstate your revenues on the income statement, then profit will be overstated. Consequently, the stockholders' equity on the balance sheet will be overstated. So Enron did that. They also kept liabilities off of the balance sheet by setting up business units all over the world and pushing their liabilities, pushing their debt to those business units. So if at the time in the early 2000s, I were a financial advisor and I looked at Enron's exponential growth, I would advise my clients to invest in that company. You would be a fool not to invest in Enron, because simply looking at the revenues, you could see this huge expansion and growth potential. However, all of these revenue figures that Enron reported were falsified. They were not real. So as a result, the company had to file for bankruptcy. It was at the time the biggest bankruptcy in U.S. history. A lot of people lost their jobs. They also lost their life savings because Enron paid in their employees incentive compensation in company stock. So as a result, and I'm gonna skip and go to slide 5. As a result, Congress passed the Sarbanes-Oxley Act. So Sarbanes-Oxley Act was passed by Congress in 2002, and per the act and all the subsequent revisions, publicly traded corporations, they are supposed to design a system of robust internal controls. The company's managers and auditors are supposed to document and verify that those controls are working. So internal controls, now I'm going to go back on slide 4. Internal controls are policies and procedures set by the company that safeguard assets. They also are designed so they can ensure that the accounting principles applied by the company are reliable, and they encourage ethical operations. So, needless to say, Enron is not in business anymore. Because of the accounting scandal, there were a number of their executives that went to prison. One of them actually died between the sentencing and the time he was supposed to go to prison. The other one, he just got released back in 2019. So there are consequences, there are severe consequences if a publicly traded corporation um, engages in fraudulent activities, defrauds not only their investors, but their employees and the public in general. What's interesting about the early 2000s is that Enron was not the only company engaged in accounting scandals. Another company in the telecommunications industry called WorldCom, they also misrepresented their financial statements. But instead of falsifying revenues, they decided to falsify expenses. So instead of reporting expenses on the income statement, they moved $11 billion of expenses to the balance sheet and reported them as assets. Again, you guys by now are educated users of financial information, so you know what that does. Not only the company's profitability was affected, but also the company's assets were increased as well. So let me see. I think there is a question. Yes, it's pretty impressive, Janelle, isn't it? $11 billion just like that became part of their profit and increased their assets by that much. Anyway, so let's look at some principles of internal controls. This is slide 7. Please understand that for those of you who will be accounting majors, you guys will take a whole 16-week class on internal controls. So I'm going to cover this very lightly. So again, please understand that if you are going into the accounting and finance field, not only you'll take classes on internal controls, you'll take business ethics. You'll also have to take ethics for the accounting profession. So you'll have a lot more understanding of internal controls. One of the things that happened with the Enron scandal, their external auditors and Arthur Andersen, they were also found guilty of falsifying results. Needless to say, they're no longer in business as well. So internal controls, they're set to ensure that the company safeguards their assets and they report financial information to the external user correctly. There's several internal control principles that are common to all companies, regardless of whether they're public or private. Number one is the company has to establish responsibilities. In other words, what we mean when we say establish responsibilities is that the company has to make sure that one task is done by one employee. In accounting, we like records, we like paper trail. So one of the principles of internal controls is to maintain adequate records. A few other principles of internal controls. The company must ensure the responsibilities are segregated. They're dividing responsibilities for related transactions. They apply the principles of restricted access. For example, if they're trying to design internal controls over inventories, and they determine that inventories need to be kept in a warehouse, that warehouse should be kept under lock and key, and only employees who need access to do their jobs will get access to that. In addition to different physical controls, the company must apply technological controls. I'm sure you guys all have your passwords to access TCC's website and Blackboard. I have my password. I'm given different access than you. And then last but not least, the company must ensure that that everything is done correctly. So independent internal verification is key. So let's look at those individually. When we are discussing establishing responsibilities, the company has to make sure that tasks, duties are clearly established. So you guys have applied for jobs before, so I think of this as the job description. So when I was working in the corporate world as an accountant, I was supposed to prepare journal entries, and I was told exactly how to do that. So tasks should be assigned to one person. By doing that, we reduce the possibility of fraud. If tasks are assigned to one person, that we can easily determine who made the error or who is at fault. So here's an easy example. When it comes to establishing responsibilities, let's say you have two employees working at the movie theater. One of them is the one who is taking the tickets as customers are walking in. The other employee works the concession stand. Let's say that they get into the habit, just so they're not bored, to change jobs throughout the course of an evening. The first one will start taking tickets, and then a few hours later they'll go and work the concession stand. That would be a clear violation of establishing responsibilities, because there will be absolutely no way to tell who made an error if an error indeed is made. When we discuss documentation, or what I earlier called paper trails, those detailed records really are necessary to protect assets. In accounting, we cannot make a journal entry unless there is a source document that proves that the transaction happened. So whenever we look at those adequate records, we can easily see that from an accounting perspective, they include those source documents, so invoices, purchase orders, anything of the like. Those records include the chart of accounts, which determines what accounts are used for what purpose. Any kind of pre-printed form or pre-numbered checks or pre-numbered sales slips that helps the company's auditors and accountants to track transactions easily are also part of the maintain adequate records internal control. When we look at, in order to ensure assets and bond key employees, the company has to be insured against losses, and employees that handle a lot of cash needs to be bonded. So what bonded means is the company has an insurance policy that ensures that in the case of theft by the employee, the company will be protected. There are other internal controls, such as separate record keeping from custody of assets. In other words, the person who controls the asset must not have access to the accounting records. The reason why we do that is because if you are, let's say, the cashier and the accountant, you can steal cash from the cash drawer, and then as an accountant, you can update the accounting records to conceal, to cover the missing asset. Segregate duties and responsibilities. That's another internal control principle. In this instance, we call the division of responsibility segregation or separation of duties. And by doing that, what we're ensuring is the one person will act as a control. That one person will check the other person's work to prevent fraud or errors. Again, I will not ask you detailed questions on the exam on the internal controls. You guys have to recognize the different principles, but I won't ask you to define them. I just want you to recognize them. So let's look at the limitations of internal control. It doesn't really matter how hard we are at work setting up internal controls. There is always the human factor. So anything from carelessness, confusion, misjudgment, or intentional human fraud will always limit the effectiveness of internal controls. So earlier, I showed you, or I talked to you about the accounting scandals that prompted the Sarbanes-Oxley Act. That was back in 2001, 2002 timeframe. Fast forward to 2009, even though the Sarbanes-Oxley Act was already in place, even though it required companies to promote internal controls, to set strong, robust systems of internal controls. Think about what happened in 2009. The mortgage industry collapsed. The U.S. automakers needed to be rescued. There were a bunch of companies in the financial services industry that engaged in the same type of fraudulent activities Enron did 7-10 years prior. So the reason why we have to discuss internal controls in this chapter is because, again, internal controls have to be designed to safeguard assets. One of the most valuable asset the company has is cash. So this is really the important part of chapter 6. As I mentioned earlier, today's live lecture will just talk about a few theoretical pieces of information. On Wednesday, I'll teach you how to prepare a bank reconciliation. So control of cash is important because, as I mentioned, cash is one of the most valuable assets any company has. So if the company is supposed to set up internal controls, in order for those internal controls to be effective, they have to protect cash, they have to protect cash equivalents, and they have to meet the 3 basic guidelines on this slide. So the first guideline, the when designing internal controls, the company has to keep in mind is that the person who handles cash should not be the same person who accounts for cash on the books. One example, and I understand this is partially an example that deals with cash. One example that I have is a few years ago, I was teaching a student working for a company downtown Fort Worth, and she told me a story of the company she was working for at the time. So they had the HR manager handle the payroll as well. So the HR manager, when you guys think about what that person does, the HR manager is in charge of recruitment, in charge of bringing employees in for interviews. Eventually, when an employee is selected, they're in charge of onboarding them. So what happened in this particular company, and that was in the Star Telegram a few years back, was that the HR manager hired a fictitious person. That person didn't exist. No one ever knew that that person was hired. But that person had a very real bank account. So because she was also in charge of payroll, she paid that fictitious person with the real bank account. And that went on for 5 years until the auditors figured out that an employee by such a name does not exist. So the fact that the HR manager and the payroll person were the same person violated this control or guideline for setting up internal controls over cash. We have the same person hire and pay the employees. So there are a couple of other guidelines that we need to talk about. Cash disbursements should be made by check. These days, I feel like this is a little obsolete because most cash disbursements are made by electronic funds transfers, and cash receipts are deposited in a bank. You'll see that even though the bank is an external organization, it is one of the strongest internal controls because it gets cash out of the company, and the cash is safeguarded or kept safely by that external organization. So what do we call cash? Cash is everything: currency, coins, dollar bills, and everything in the company's bank account, customers' checks, cashier's checks, all of that we call cash. Cash equivalents are actually short-term investments that are very liquid, that the company can convert, the company can turn into cash very, very quickly. So all of these things, cash and cash equivalents, are very liquid assets. Cash is cash, and then cash equivalents can be turned into cash fairly quickly. The company must efficiently and effectively manage their cash because think about your own cash payments and cash receipts. You have bills all the time. In order to pay your bills, you have to ensure that you have cash to do so. So cash management includes the planning of cash disbursements and planning the cash receipts to meet those disbursements or payments when they're due. So the company's cash management includes keeping a minimum level of cash that's needed to operate. So there are a few things that we can do to bring cash to the company quickly. If the company has a lot of credit sales, we can encourage the collection of accounts receivable outstanding quickly to make sure that the customer pays as soon as they possibly can. We can attempt to delay payment of liabilities by negotiating with suppliers and asking for extension on payments. In addition, the company can keep only the necessary assets for operations, plan expenditures, and invest the necessary cash. So let's talk about cash receipts and cash payments. I'm going to skip directly to slide 23. So let's talk about errors when, let's say, the cashier at the store makes an error in making change. So whenever we discover those errors, small amounts are debited or credited to a cash over and short account. So let's look at an example here. The cash register shows $550, but when they count the cash, there's $5 extra in the cash drawer. If that's the case, the cash from the cash drawer will be deposited to the cash account at $555 because that's what's physically present in the drawer, and then we'll credit cash over and short account. The cash over and short account, you can see that this is the increase to cash over and short is done with a credit. So that tells you that this is some kind of a revenue-like account on the income statement. That revenue-like account would increase profitability and will decrease, it will increase profitability and it will increase stockholders' equity. So if you look at the next slide, if the opposite is true, so the cash register shows $625, but when they actually count the cash, they only find $621, that difference of $4 will be debited to cash over and short, because now cash over will decrease profitability and it will decrease stockholders' equity. So I'm going to scroll down. I'll skip a few of these slides because they're relatively unimportant. I want to talk to you about petty cash. So remember how we said that cash is coins, bills, checks, anything of that nature, plus cash equivalents. Well, petty cash is cash on hand that the company keeps just so they can reimburse small payments for things like shipping fees, small repairs, low-cost supplies. When I was working for ExxonMobil, we would very frequently pay for pizza out of the petty cash fund when working late. So when the company sets up a petty cash fund, we call that establishing a petty cash fund. This is another concept that I feel is a little outdated because really, if you look at most large publicly traded corporations, rather than using a petty cash fund, they all use purchase cards or just their corporate credit card. But we have to go over this material anyway. So when we establish a petty cash fund, we'll debit petty cash to increase the amount on hand, and we will credit cash. The way I think about this is we're basically moving cash from one pocket to the next. So once this journal entry is prepared, we debit petty cash, credit cash. At that point in time, we know that the petty cash fund is established and the company has $75 to pay for those small payments for the pizza that I told you, maybe for a parking meter reimbursement, for a small repair. Once that happens, the company is ready to use the $75 that we looked at on the previous slide. Throughout the period, the person who's responsible for the petty cash fund, we call that person the custodian, they would keep track of every single thing that they have paid for out of the petty cash fund. And you can see a list of those cash payments provided to you. So there was tile cleaning on November 27th, and then on November 15th, they purchased office supplies that are immediately used. So the custodian keeps and prepares this petty cash payments report. What we can see right now is that the company started with $75. They used up $71.30. So the fund has to be replenished. The cash payment report is the source document or the document that backs up the journal entry to reimburse the fund. And you can see here how we're debiting all those various expenditures, and we are crediting cash to reimburse the payments that are made out of the petty cash fund. I'm going to go back to slide 32. See how rather than making a journal entry every single time a small payment is made out of the petty cash account, we wait until the end of the period to prepare a reimbursement. The reason why we do that is because the amounts are so small that the time of an accountant should not be wasted to prepare journal entries every time the company's custodian makes a reimbursement out of the cash fund. All right, so we showed how we reimburse those expenses to petty cash. Sometimes, though, the company might choose to increase the petty cash fund. The way we increase the balance in that fund is by debiting petty cash and crediting cash, which is essentially the same journal entry that we prepare at the time the fund is established. To decrease the petty cash fund, we would do exactly the opposite. Cash will be debited and petty cash will be credited. Sometimes, just like we saw with the cashier's drawers earlier, there may be cash over and short situation. So if the petty cash custodian does not get a receipt for payment, and there is no document to back that amount, this will result in a cash over or short. So the petty cash payments will be left in the account, but it would not equal the total fund balance. So when we have a cash over or short situation, just like you saw earlier, we will debit cash over and short when we're actually short, and that account will act as an expense. It will effectively decrease profitability. All right, so petty cash, remember, is a very, very small amount that the company has on hand. The large cash amounts would be kept at a bank. So the bank offers certain protections for cash. So the bank, like I said earlier, is considered one of the strongest internal controls because it is a more secure, safer place for the company's cash than keeping the cash in the office. So there's some basic bank services such as signature cards, deposit tickets, bank statements. These are all things that the bank does to ensure accurate tracking of the company's cash resources. So let's look at a couple of things. Deposit tickets or deposit slips, they are used to deposit money in the bank. So by obtaining a deposit ticket, we are following the documentation procedure internal control, where we need a document to back up a transaction. So the deposit ticket serves as proof of deposit, and the company's accountant at that point in time can increase the amount of cash on the books. Checks, we can withdraw money from the bank with a check. So the check is effectively another one of those documents that ensure proper documentation procedures and safeguarding of the most valuable asset the company has, or cash. The bank statement shows, just like your own bank statements, all the ins and outs of the company's bank account. So you can see the checks and debits and the deposits and credits here. They're listed chronologically, and they show not only the deposits or the ins, the outs, but the current balance. The bank statement is something that we will learn how to work with next time when we discuss the bank reconciliation. So again, today we're not going to be preparing a bank reconciliation. We'll just talk about it. Next time we'll work a couple of problems on Connect, as well as a problem, a worksheet that I'm going to show you how to do by hand. So the bank reconciliation basically is a comparison between what the bank says the company has at the bank and what the company's accountants say the company has on the books. So basically, we'll compare the bank statement to the cash account. A bank reconciliation is prepared periodically. Most companies that I've ever worked for, they prepare a bank reconciliation once a month. So the bank reconciliation compares the items and reconciles or shows the difference between what's on the bank statement and what's on the company's books. Most discrepancies between the bank and the books exist because of timing differences. So for example, if the company has made a deposit, but the deposit has not been reflected on the bank statement, that would be an example of a timing difference. The company knows that they have sent the checks for deposits, but the bank has not received them just yet. Also, outstanding checks. If the company writes a check, the bank has no idea that the company has done that. So that would create a timing difference. That would create a discrepancy between the amount on the balance sheet and the amount on the bank statement. So this is what we're going to learn how to do next time. We'll look at the bank balance and make certain adjustments. We'll look at the book balance and make certain adjustments. Some common adjustments on the bank side include deposits in transit, outstanding checks, and then bank errors. On the book side, we have interest and cash receipts, bank fees, and then corrections of book errors. So I'll show you real quick a bank reconciliation. You can see that we're starting at two different amounts. The bank statement says the company has $2,050, but the company's accountants show that in the books, in the cash account, the balance is only $1,400. Remember, we will always start with different balances. If those balances are the same number, then you don't have to prepare a reconciliation. It's not necessary because there's nothing to reconcile. So now look at the bank side. In order for us to prepare the reconciliation, we have to look at every single timing difference. One of them would be deposits in transit. Deposits in transit would increase the bank statement balance. Outstanding checks would decrease the balance. But remember, on the book side, the company already knows what deposits they have sent in and what checks they wrote. So the adjustments over here on this side will be completely different. So for example, the collection of a note receivable and interest earned, these are items that the bank has knowledge of, but the company doesn't. The bank has collected a note on behalf of the company. The bank also has charged the company fees for non-sufficient checks and check printing charges. So the company doesn't know about that, but the bank does. So the adjustment for these items will be only on the book side. So again, tomorrow we'll talk about, no, I'm sorry, not tomorrow, but on Wednesday, we'll talk about how to reconcile books to the bank step by step. One thing that students always forget about once the bank is reconciled, once the bank reconciliation is prepared, once we arrive at the same answer, we can't stop there. We need to prepare several journal entries to show the increase or the decrease in the cash balance. In addition to bank reconciliation on Wednesday, we will work a few problems that will teach us how to compute days sales uncollected ratio and how to use that ratio to assess the company's liquidity. So please read chapter 6. And when you come back on Wednesday, we will spend the whole class period, the whole lecture, working problems. Do you guys have any questions?